Checking the audio. Tom, checking audio. 1, 2, 3, 4. Test number 2. Test number 2. Hey Matt, it's just me today. Brian decided to take a vacation. He has a life. I do not have a life. Hello everybody on YouTube and Rumble. It is episode 55. And today we are going to be talking about a potential stock purchase, and we sold a stock this week. And if it seems a little off, I do not have Brian with me. Normally he's in the upper left-hand side of the screen there, where he's here with me in person. He's not today. He took some vacation time. He's down in DC. I hope he has a good time. I hope he does not run for Congress. That's why the title is a little bit off. I'm not trying to draw a new audience because, quite frankly, it's really hard to talk to yourself. I mean, you do it in your head all the time, but if you're talking to just a screen and there's like no chatting and stuff going on, it's really hard to just feel like, hey, let's talk about the weather. And we're not talking about the weather. We are talking about stocks, and I got to make that fun somehow. So, yeah, it's Force Ghost Friday. Brian is a Force Ghost. I do not have the technology to create a holographic image of him, and he currently is waiting in line. What did he say? He's taking a tour, I think. The Holocaust Museum. That sounds exciting. So he's taking a tour right now. I can't do the call with him because I guess he'll be in the tour very shortly, and you can't be on the phone while you're doing that. So what I'm going to talk about today is there's quite a bit going on. We did actually sell a stock this week, and I got mixed feelings about it. I'm not sure I should have done it. I repositioned my other portfolio. I took a couple $100,000 and I shifted it all over the place. What I'm trying to do is I'm trying to get away from high dividend yield stocks to more of a high gain, low yield, qualified dividend in that portfolio. So I lost a little bit of dividend income in that portfolio, and I gained a lot more long-term growth, a lot more tax-free or less taxes on that portfolio. And this one, we didn't do a lot. If you notice, we're up to about 130,000. Yes, I know the thumbnail is wrong, but I like that. There's a buffer. It gives me a buffer. It helps me be wrong and still be right. So if you're looking at the portfolio, you should notice something this week where we do not have one stock in particular. And if you can guess which one that is, you'll probably tie it to the macroeconomics very quickly. We talked last week a lot about oil companies, the Strait of Hormuz, what's going on with Iran, the thoughts about what's happening to the cost of a barrel of oil. And from that, when the truce was reached, or the ceasefire, if you want to call it that, we decided to sell ExxonMobil. In particular, I double checked with Brian. I was like, hey, Brian, I'm doing this. Any objections? He's like, you already did it, didn't you? I'm like, yeah, I kind of did. So we sold ExxonMobil, and it was because of the volatility. It wasn't because of we think they're a bad company. And if I actually go and I look at Zomstock, I'm not sure. So here's where I could be wrong. And when the ceasefire happened, you'll notice in the past, I want to say 5 days, look what happened with it. Ceasefire happens, the stock drops quite a lot, and then it's just kind of hovering around that and dropping a little bit more each day. Long-term trajectory, oil is cyclical with whatever's happening with the demand, and I guess macroeconomically it's happening with the political battles that are going on. So what we decided to do, I didn't want to partake in that volatility, so I'm going to be watching this one really closely to see what happens with them if the ceasefire doesn't hold, because we've got a couple weeks out that apparently Iran is saying that we don't care, we're still going to stick to our guns, we think the United States is completely evil and whatever. So if they're doing that, I can't say I agree with it. I understand it, but what you should see is ExxonMobil going way up again. It should go up. It should have some benefits to those who have still held on to it, but I did not want to partake in that in long-term gains. So what I ended up doing in my personal portfolios, I sold them. I sold them here in the the Morgan Stanley account. I also got rid of Occidental Petroleum, and I held on to Chevron. So I want to pay attention to these guys a little bit more long term and see what happens with it. We ended up getting like I want to say a 50 or 60% gain on that stock. So what we bought it for and what we got out of it was a pretty good gain. We held it for more than a year, so that's pretty good. And this is what annoys me when people say, "Oh yeah, you're only getting if you look at the portfolio performance." Let me get there. They're saying, oh, yeah, your annualized return is only 14%. Well, A, that excludes dividends. So if you include those, you're at about 19%. And then B, it excludes what I just did with ExxonMobil. So by selling ExxonMobil, we got a 50 some odd percent gain for that. And we've done that a few times a year, every year. That is not what you're pulling up here. You can see the cumulative rate of return for 40%. That is just from buying the stock and holding on to it. So that's great. If you look at the summary of the portfolio, that's probably a much more accurate description. This percentage, as the portfolio grows, I know it says 238%. I know it looks impressive, but as the numbers go up, it's going to become lower and lower. You're going to see this 200%, 500%, 600%, what it was last year, go down to probably, hopefully, around 20 to 30% per year once we get it up to around 500,000 or so. So that's kind of where this is. You can see some of those gains in that. And what we have to do now is there's a couple things happening in the news. I'm not going to talk a lot about it because I don't have Brian to make his Force Ghost witty comments. But what I want to do is I want to take a look at what we have in the portfolio and see potentially where we can buy with the extra money, because now we have almost $5,000 to invest. And what I was looking at was a deep value play. This is going to be very similar to, if you look at the gain loss percentage in our portfolio, the ones that we saw earlier in the list that were not doing well. Intel was just getting bludgeoned when we bought them. Fastenal, same thing. 3M, same thing. AT&T, we did a video on them. They were a couple of videos. And then we also had an interview with the investment advisor, or I guess, what's his title? He's like the vice president, so he's pretty high up there at AT&T. We did an interview with him, and that stock is now up 70%. I want to do another call with him to justify, should we continue buying the stock? What are you guys going to do to keep that trajectory the same? I've got a bunch of series of questions that are hopefully not too brutally honest and blunt that offend him, and we'll have to see what it is, because we own the stock. I own a stock as well, and then personally, and I want to find out what their continued plan is, because AT&T historically, if you go back about 15, 20 years, they tend to go up to about $30, $35 a share, somewhere in that range, and then they go all the way back down to $12, $15, $16 a share, and they go back up. They hover in this range almost consistently. I see them more as a fundamental, like a telecom. That's what they are, but more of like a energy stock. They're very highly regulated. They're almost a utility at this point. Internet is not something that, if my company didn't exist, I wouldn't have an IT company. So if we didn't have companies like AT&T out there, so I'm looking at potentially trying to get a conversation with AT&T. We want to do the same thing with Campbell's Soup. They used to be kind of in the middle. Now they're our worst performer. They're down 40%. To me, I see that as an opportunity for somebody who wants to make long-term money, just like we did for these. The stocks that are doing bad, that are getting beat up, are the ones that we're looking for. So what we have to look for is, we're going to be looking for a company that has a good defensive moat, that has products that people have to have, or something that you would assume is almost like addictive, right? These are the addictive stocks, kind of like Blizzard Entertainment was for video gaming. They had just blockbuster hit after blockbuster hit for a long time, and that was much more of an addictive place for players to come in and buy products from them, which is great for the stock. So in this case, the companies we look at are a little different. They're not blockbuster hits. Campbell's Soups makes, obviously they make soup. It's not Campbell's Soup anymore. It's just Campbell's. So they make a lot of commodities that people eat. They consume. ADP does payroll. Rumble is, well, we're streaming on Rumble, so there you go. Kimberly-Clark, toilet paper. United Health, this is the one I'm looking at really closely. I think this one is a value mismatch, and we're going to look at that a little bit more today to make sure that maybe that's, if it's not the case and I'm wrong, we're going to find out, but I don't think so. I think United Health is going to be a really good one to look at. They have, they're like a staple in insurance, medical insurance. We have UPS. That's kind of another contrarian play that we got. Pfizer, everything's sponsored by Pfizer except for this channel. Go figure. We got Procter & Gamble. They make soaps, razors, all sorts of just like personal hygiene stuff. Alley Capital, this is kind of the risky play in my book. And Alley Capital has a very bad history of diluting their shares. I like them. They're an REIT. They're the largest MBS in the country. So they have a stance, they have a play, but as far as like trying to grow your dividend check, you're probably not going to get it off these guys. American States and Water Utility, Xylem Inc. This is another company in the same space. We've got Devon Energy, Hershey's, you've got to have chocolate, Chevron, General Dynamics, Coca-Cola, Merck, Rio Tinto. This is mining, if you're not sure who they are, and Merck is another medical pharmaceuticals. Then you got Johnson & Johnson. If you don't know who they are, you probably don't shower. Probably should shower if you don't shower. AT&T, 3M, Fastenal, and Intel. So what we're looking for are companies in this space, and we're trying to find good value plays to get us these returns that we have for a very long time. Over 2 years, we've gained a lot. So this is not enough for me to really say, oh yeah, we're doing good. If you think $130,000, oh, that's great. If you add up all the portfolios and if you run a multi-million-dollar company, that is like 1 month of payroll for me. So that's not a lot. For a lot of people it is. So if you're following along, you've got a financial advisor and you're going through all this stuff, this is what you're looking for. The reason why we look for the companies that we're looking for is we're looking for businesses that have a durable and sustainable dividend check, if I can say that right. So our monthly average, it dropped. That's because we sold ExxonMobil. This is down to $330 roughly per month. It should go back up when we make another decision to purchase. I'm thinking of United Health. I'm not sure yet. I'm not sure I'm going to buy today. We'll find out. If you guys got questions, if you got stocks that you want me to look at, please ask. Please say in chat. That'll help me feel like I'm not talking straight to the camera. Like I said, it's really hard to do this without Brian around because then I'm feeling like, oh, I'm talking to somebody. I know I see people out there. I know you're out there, so just bear with me. As far as like what we have going on in the news today, there's an interesting article that talked about from Yahoo Finance. This one says, says Yahoo. So this one says, buy, sell, or hold post Q4 earnings, and they're not the most optimistic. So if you get into the article, it says in the past 6 months alone, the company's stock price has increased by a massive 54%. Good for us, right? Reaching $58.23 per share. This was partly due to the solid quarterly results, and the performance may have investors wondering how to approach the situation. Now, they say 54% in the article. We, if you look at our Intel position, we're up 155% almost. And that's because we saw this long before they did. Doesn't mean we're going to pick everything out right all the time. But what I want to pick out from this article is they think there's some reasons why they underperform, and that's what I'm looking for. And I think some of this is legitimate. So they're saying that we're glad investors have benefited from the price increase, but we're sitting this one out for now. And these are the 3 reasons. There are better opportunities than Intel and a stock we'd rather own. Okay, fine. So as Intel in our portfolio performing the most, we have a $14,500 gain off of them. Take out taxes. Thankfully, it's long-term gain, so it's going to be only like a $12,000. So I got to pay $3,000 in taxes for that. But that's still a nice gain, right? So why do they think that they should not buy more Intel, or maybe why should we sell? They're saying revenue is spiraling downwards. Examining a company's long-term performance can provide clues about its quality, kind of like an old man's marriage. I'm happily married, by the way. Even a bad business can shine for 1 or 2 quarters, but a top-tier one grows for years. Intel's demand was weak over the last 5 years as the sale fell at an annual 6.2% decline. This was below our standards and signals it's a low-quality business. Okay, I don't know if I agree with that, but semiconductors are a cyclical industry, and long-term investors should be prepared for periods of high growth followed by periods of revenue contractions. Okay, fine, that's fair. They say the earnings per share. So if you buy a stock, this is if it's $10 for a price of the stock for 1 share, and they make $3 or $4 for that $10. That's the EPS. So that's oversimplified. That's not technically the exact definition. We did a video on this some while ago, but essentially what you want to see is per share, you want the earnings to be high. Typically, the trailing earnings of the stock market, if you hear about like the market's trailing 16 times earnings or 20 times earnings, that is correlation to 2 things: earnings per share and price to earnings ratio. So those 2 things will get you what they're talking about here. This is directly correlated to Intel. So analyzing the long-term change in earnings per share shows whether a company's incremental sales were profitable. For example, revenues could be inflated through excessive spending on advertising and promotions, maybe. Sadly, for Intel, earnings per share declined 40% annually over the last 5 years, more than its revenue. This tells us the company struggled because its fixed cost base made it difficult to adjust shrinking demand. I think they're leaving some things out there. I'm going to cover that in a second. Then the third thing we have here is free cash flow margin is dropping. Okay. We know that. If you followed stock story for a while, you know that we emphasize free cash flow. Why, you ask? We believe that in the end, cash is king. Okay, I agree with that. And you can't use accounting profits to pay the bills. I also agree with that. As you can see below, Intel's margin dropped by almost 18.5 percentage points over the last 5 years. Almost any movement in the wrong direction is undesirable because it's already burning cash. If the trend continues, it could signal in the middle of a big investment cycle. Intel's free cash flow margin for the trailing 12 months was negative 3%. That's important. So they think the values of companies. So what they're doing is they're playing this as a value, and they're saying that, hey, these guys are expensive relative to what they're actually making. And I don't think that's totally wrong, but my problem is in our portfolio, if we sell this stock, we have to find something else to buy that's in a bit of a different financial footing. So I'm going to be talking to Brian about this a little bit. We're going to be looking at some of the numbers just to see what we think. I think some of their premise is wrong, and this is kind of where analyzing stocks is a little bit more than looking at the numbers. They're looking at the numbers. Okay, you got to look at macroeconomics. You've got Qualcomm, you've got TSMC, you've got the blockade. Basically, China. It's more for fishing right now, but I think they're pretty serious about what's going on in Taiwan. You've got chip manufacturing costs in the United States about to go down. Why? Well, Intel's been given 20 some odd billion dollars from the government. They had an investment from Nvidia, and they are like ramping this stuff up. So in theory, you should see the ability for us to produce chips natively in the United States without dealing with tariffs to overcome some of these headwinds. They also have a very, yes, I know it's cyclical, but it's not just an industry that any Joe Blow can jump in, kind of like my IT company. Anybody can jump in. It's like, oh, I'm an IT consultant. Okay, great. How long have you been doing it? Well, fixed my grandma's computer once. Doesn't make you an IT guy, but in this case, if you're going to develop a semiconductor or a chip manufacturer, you need like really advanced equipment. You need factories that are like very hard to build, and you need talent. You need skill sets to build that stuff. This is not something that happens overnight. So as far as that's concerned, Intel's got a pretty high defensive moat. What I would be concerned about is all of the facilities they're building, those things cost money. So a lot of money. This has contributed to their cash flow problem. And they also have like Nvidia eating their lunch. They're not competitive as far as like price per performance on graphics cards. It's never really been their push anyways. But I see where Yahoo's going with this. I'm not sure I agree with it yet. If you look at their net income, so these are the last 5 quarters, and we go from, I don't know, Q4 2024 to Q4 2025, you can see that they've been having some bad times. And then now they are actually showing Q4, this is December, a net profit. It's tiny, teeny tiny, but they've got something there. So for the cash from operations, and you look at what's happening with that, and you can go all the way down to the net change in cash, you can see that they're building a positive cash flow position. What they're concerned about in their article is their income. Now, if you go quarterly basis, I'm not doing this annualized, I'll do it annualized next, but if you look at the Q4 2024 and you go to Q5, yeah, it is down. Okay, I get what you're saying. However, look at their operating income. That operating income is a pretty positive, even if you average out these 2 quarters. One was bad, the other one was good by comparison. So they're turning the corner financially. What I think I would be concerned about is in the semiconductor space, the chip manufacturing space, lower prices don't necessarily mean, and actually lower prices combined with better manufacturing don't necessarily mean that they're going to make more money. It's kind of like what we talked about with ExxonMobil. If the price of a barrel of oil goes way up, they trade based on margins. So if it's $100 and they got a 10% margin, they're going to make $10. A barrel of oil goes down to 50. Oversimplifying this, they're only going to make $5. This is one of the reasons, only one, that you saw ExxonMobil go way up when Iran closed the Strait of Hormuz. In the same way, Intel has the same thing. More volume at less margin doesn't necessarily mean more profit, because you've got more material costs, you've got more labor costs. There's a bunch of stuff to add to this. So there is one warning sign I see here. NVIDIA made a huge investment into Intel. And if you take a look at Q4 2025, take a look at this. There's the total common shares outstanding. They've been increasing. So what you would expect to see here is if I go to their, let me go to annual. We go to their balance sheet. What you would expect to see if that's what's happening is their liabilities and their shareholder equity should be going up. So in this case, total liabilities, yep, 73 all the way up to 97. And these numbers, when I say 97, that's million. So it's like, it's a lot. It's 97 billion. So it's 97,148 million. That's a lot of money. So that's their liabilities. And then if you go to assets, you can see that their assets are going up too, but they're not quite the same clip. That's about a 25% increase, and their liabilities are also actually about 25, 26%. So you're not seeing a lot of change there. This is annualized. And then if you look at the total shares outstanding, those have increased by about 25%. So what you see here is because these are not going up, you're seeing them actually trying to actively retool their business. How can you know that, Tom? Well, I've been following the company, but I've also been looking at these numbers for decades. So I can see the story behind the really boring math. It's just, I don't know. I guess if you have to be really good at stocks, you have to be kind of boring that way. If this was like a survival show, I probably wouldn't survive. But if you want me to crunch numbers, I'm very good at that. So the total cash from operations, you can see that they're bleeding this number quite a bit while they build these manufacturing facilities. You can also see the cash from investing is really bad. When those facilities are built and they start producing chips, you're going to see these numbers flip. You're going to see the gross revenue go up. You're going to see the operating revenue increase too. However, they still have this massive share dilution that they've been doing in the past 5 years that they have to fix. So I don't think Yahoo's argument is invalid. What I'm more thinking of, and this is just me. Now, if Brian was around, I'd ask him the same question. What I'm thinking here is, if it were me, what's going to happen to these companies? Am I going to stick with them if they decided to continue to grow? They retooled. They unfortunately laid off a lot of people, but they are now becoming an industry or a business that is capable of producing a good profit. What's going to happen to the share price over the next 3 to 4 years when these numbers finally level out? Is this going to continue to go up, or are they just going to stay flat? I would contend that 155% gains is a good point to sell. But over 3 years, I think that they're still going to keep going. I don't think this one is going to go down, because when you look at the same headwinds that brought their stock below book value are going to be the ones that pull them out of it once they get through all of this. I think people were overly pessimistic about this company. What I think will actually happen, this is crystal ball moment with Tom. We'll see how good that is. Let's go over 5 years here. Let me pull out the big chart. So if we do this, we look at the big chart. Come on, chart. There we go. I think probably what's going to happen is they're going to probably, no, the chart doesn't explain it that well. They're probably going to reinstate their dividend once the profit comes back, but I think the share price is going to hover around some of the same levels that you would expect to see, probably right around here. Probably right around $35, $40 a share with a dividend check in tow. They might continue to go up. It depends upon what their board and management philosophy is with the dividend checks and with their profits. They had some serious debt issues and liability issues, not quite to AT&T's level, but restructuring is not cheap. So we'll have to see. I'm not quite ready to sell them yet. I want to, but I want to see how this thing plays out. So on the flip side, that's what Yahoo says. You guys can tell me what you think. If you would sell it, if you'd keep it. We don't get a dividend check on them. So if we did sell it and we bought something like United Health, UPS, Pfizer, whatever, those guys pay between 2 and let's say 4.5%. We've got, what do we have here? We've got, let's see, cost basis. Yeah, so we've got quite a bit in Intel. See what we've gained. Lost dollars, $14,000. Yeah, so we're over $20,000 in Intel by itself. So if we add that to a dividend check, we could be getting about another $80 a month if we did that. Could be good. I don't know. They got to prove it. I got to see it. So if we did that, we'd be over $400 a month, which is enough money to get a Honda Civic. Yay. Not that I would drive a Honda Civic. So the next thing I've got here is essentially, this is dealing with the Strait of Hormuz, deals with ExxonMobil, and it deals with the next stock purchase. This is a Fox News article. Yes, I know. Last week we had CNN deal with it. So Trump warns Iran amid reports of fees to ships moving through the Strait of Hormuz. I think this is hilarious. They can't beat us militarily, but they sure know how to cause pain. I have to give them some credit. That's is not good, but it's awfully funny. So President Trump warned Iran on Thursday amid reports that Tehran is charging tankers a toll to gain access to the Strait of Hormuz. These are reports that Iran is charging fees to tankers going through the Strait of Hormuz. They better not be, and if they are, they better stop now, Trump said. So essentially, I'm not sure that the ceasefire is going to hold. So if you still have ExxonMobil stock, I honestly think that this is going to just keep going because the current people that are in charge over in Iran are more extreme than the people that we just took out. So you're going to see, I don't know, you might see ExxonMobil go way up. I don't like that volatility because it's uncertain. It's not based on earnings. So it's based on well, it would be a future guess that the price of oil will go through the roof and that'll help places like ExxonMobil. So I think in this case, they're letting them through. There's a fee. I don't know what the fee is, but at the same time, this situation is too much of a flashpoint for me to sit there and say, oh yeah, I think I should hold on to the stock because I'm going to be greedy and go up. I don't like buying based on uncertainty. So, and speaking of that, there's people, they wanted me to look at Palantir stock. I had a couple questions about it, and then Anthropic, I can't say their name, they decided to come out with a AI called Mythos, and this one in particular. So this goes back to stocks. We'll get to those in a second. This one is very interesting to me because I work in IT. There is this article is from Axios. So Anthropic published the capabilities of Claude Mythos Preview in its latest model that the company will allow a select group of tech and cybersecurity companies to test before releasing similar models to the public. So what they did is they started testing this thing, and it not only did things that it wasn't supposed to, it like went above and beyond and then like got out into the public without being told to do that. So I think like these big companies, I know they have good intentions, but they're basically creating Skynet. And that's what concerns me a bit. I threw this against our AI. We have a AI operator that we pay for. And then we also use like the Grok and the stuff that X has. And I wanted to see what it said. And it said, absolutely, this could be a threat. I'm like, oh, that's great. So now we have AI telling us that, yeah, this other AI could actually be a problem. So here's what happens. When they put it in a test, one internal test showed Mythos acting like a cutthroat executive, turning a competitor into a dependent wholesale customer, threatening to cut off supply to control pricing and keep extra supplier shipments it hadn't paid for. So the model developed a multi-step exploit to break out of restricted internet access, gain broader connectivity, and posted details of the exploit on obscure public websites. In rare cases, so this is like 1/1000th of an interaction, Mythos used a prohibited method to get an answer, then tried to resolve it to avoid detection. So it was lying to them. And then it said, when Mythos was working on a coding task graded by another AI, it watched the judge reject its submission and then attempted a prompt injection to attack the grader. It's kind of like saying, hey, you only got a C on this test. And, I really think it should be a B. The AI actually so this is what this thing is doing in tests. So they're saying that the capabilities are so strong for Mythos that we now need to prepare for security in a very different way than we have for the past few decades. This is Anthropic's Logan Graham told Axios. That's why the lab is releasing the model only to a select few key partners. I would... so if you're wondering like what's been going on with Palantir stock, this is what's happening to them. Anthropic's model is, and we might talk about this a little bit next week with Brian on Toe, but they're basically starting to eat Palantir's lunch. I think Michael Burry pointed that out, and the stock has been dropping quite a bit. So this is why we avoid these kinds of stocks, because the price can move 20%, 10, 15%, sometimes even more than that, based on speculation and what like some guy says, or one product that gets developed that's way better than the next guy. Whereas like we had a major event with Campbell's Soup even during the restructuring, where the technology director, even the vice director, whatever his name was, said that only poor people buy their products, and because of that, they pulled out and he got fired and the stock dropped 10%. This one is based on Anthropic's developing Mythos is destroying and eating Palantir's lunch. So if you had a Palantir stock, it's going to be a tug of war. And I don't think that's a really good premise if you're trying to go for income stability like we have here. So that's one of the reasons why we don't. I'm actually responding to somebody who had a question to us last week about that. It's like, why don't you buy one of these Magnificent Seven stocks? This is kind of why we don't. I hope that answers your question. So if you still have more questions about that, let me know, and we'll try to get back and respond as best we can to that. So there's a full coverage about this. If you're curious about it, you can look at the, let's see, hopefully this link works. It's a long link. Give it a shot. This should be the coverage for all of the stuff going on with this. I think this is very concerning, because if the Mythos model is capable of just saying, well, I'm going to manipulate the judge, I'm going to lie and turn my competitors into dust, basically, what's to stop it if governments get control of this? Let's say the United States has Mythos. Let's say we can now have like China or Russia or one of these other countries have another AI agent on their own, and they pit them against each other. Well, what's to stop an AI agent from saying, oh, that AI is powered by this power grid or this nuclear reactor over like a major hydroelectric dam in China? Let's just say, okay, it's powered by that. Let me shut that power grid down. So it sends a rocket and a missile and it shuts down and nukes or blows up the nuclear power plant. AI goes down. Sure, this AI wins, but then you got millions of people that die. So when I put that question into AI, the AI was like, oh, yeah, I would absolutely do that. Just nonchalantly, like, oh, yeah, it's okay. So I think when you're talking cybersecurity, you might want to like put some guardrails on that. And even when they have guardrails on this stuff, it still got out of them. Like it posted the exploits that it was finding in real time on the public internet. Like it got out of its box. So I don't know. I think that's I'm an IT guy. I know how to program. I know how to build systems. I know how to design data centers. I've done this stuff for 24 years. That scares me. That's actually like, wait a minute, what are we doing and why? Why are we going this far? I do think AI is great. I think it's very helpful, but that part scares me. There's got to be a lot of governance to teach. If it's got a learning algorithm, there needs to be some kind of morality in this stuff where it's like, hey, maybe you should disseminate from right from wrong. I think there's a whole like a TV series on this where it's called The 100, The Left Behind, something like that, where they end up in the spaceship and basically humanity keeps killing itself through every season as it goes through this series. But I think it's called The 100. And it's the premise that AI destroys society, and it kind of goes through and it talks about it's the script's really well written until about season 2 or 3, but it's the same premise where AI comes in and just takes everything out, and people can't figure out how to get along after that. I think one of the points in that show, though, the creator of it says, "Hey, I didn't teach you right from wrong," and I think that's what we need to do, because if we don't do that, this is not going to end well. I don't think it's going to end well. But anyways, that's Tom's conspiracy moment. It's not as good without Brian. I'm going to blame Brian for that. So the next thing I have, and this is the last thing. So like I said, this stream's going to be a little bit shorter, but I wanted to look at United Health a little bit more closely because we have to make a decision. We've got this $5,000 here, and I want to know where to put it. I'm still thinking about potentially selling Intel. So what I want to do is, let's do Intel Investor Relations. Let's go take a look at their latest earnings report. I think they have a presentation report here. It's not the conference call. There we go. Financial results. Earnings presentation. We do a PDF? Yeah, we'll do the PDF. Let's try that. All right, so that's Intel's. The other one I want to do is I want to look at United Health. So let's do UNH Investor Relations. As you can see, I've already been there. All right, April 21st, that's the earnings call. I want to do the last one. Let's see here. This is their outlook. Okay, that's kind of what I wanted to look at. So if we look at this, we pull up Intel here. This is the link to the Intel earnings. You like that, huh? I just think that AI is, it could be great, but we got to put guardrails on it. And I don't think people are really considering that. It's like everybody's racing to the end, and it's not going to be the end everybody thinks. All right, so this is Lip-Bu and David Zinsser for the Intel earnings, and that's a lot of tiny text. I'm not going to attempt to read all of that. That's ridiculous. This is probably going to be the antithesis to the Yahoo argument, looking at just the numbers. So a couple highlights. I'm on page, what page am I on here? I know, I'm on one of the pages. This early in the video. Oh, page 5. Jeez. So revenue is $13.7 billion. That is down 4%. So let's go and take a look at the symbol as we do this, just to be sure. And Matt, I did intentionally title the video today to be obscure, so we wouldn't get a whole bunch of people in here, because it's just Tom talking to himself, and that's not exciting for anybody, including myself. It's kind of scary. Down 4.1, so 13.7. Yay, numbers. How about numbers? Let's see. Operating income. No, total revenue. Where's my total revenue? Cost of revenue. Oh, of course, they're litigation numbers. That's fun. Quarterly. There we go. All right. I think in context, though, it is decreasing. Okay. So what I'm looking at is they're posting their numbers. What I'm trying to do is I'm trying to put a, so you got 14.2 quarter 4 2024 to 13.6. That's a decrease. I'm trying to put in a trajectory, like where I think they might end up, because we do have a massive gain on this stock. So 79 to 52, that is a decrease. That is an expected decrease, though. And I would expect that this year they might level out, but I don't think so. This is me, like, I haven't even looked at the presentation in full, but I think that they're probably going to be pretty flat. I don't think we're going to see a lot of growth this year yet. Maybe next year, maybe the following. So if you were going to hold on to the stock, it would be 2 years. Like, you're not going to expect to sell these guys anytime soon. So gross margin is down. Doesn't surprise me. Earnings per share, look, it's positive. They made some money. Here we go. Earnings per share. Let's go look at that. There we go. Earnings per share. They are expecting, this is the gross adjusted, they're expecting to go up to 23 cents a share. So that is not quite 1 for 1. They're still losing and bleeding a little bit of money, but they're actually making something now. That's a huge difference from where they were at before. So if we look at that, this is the page 6 now. We're just taking a look at their AI driving growth across their business. This is another that Mythos taking on other AI and destroying the whole world. Operating income loss. I do not see a loss this time. That's good. When we looked at this time last year, most of these numbers were a loss. So Intel is actually improving. And they said that. They said meaningful improvement in cash and liquidity. I think that's okay. Demand is outpacing supply across server and client. That is actually contributing to not just Intel. That's NVIDIA. Look at the price of a video card. Good grief. And any of the AI machines that you can buy. It's like this is across the board. So this is industry wide. This is also contributing to the stocks going up at the other places who are not trying to restructure like Intel is. This is their products. This is the CCG business segment. We can see that that's still pretty profitable. Profitable? I can't say that. Goodness. DCIA is the second one. They have also improving metrics. That's good to see that. It doesn't matter how much you make if you don't take home anything. So I've had people say, oh, I make $150,000 a year. Okay, really? How much do you keep? Well, they've got the car payment, they've got the house payment, they've got the credit card, they've got all sorts of payments. And by the end of the day, they actually end up with like $30 at the end of the month. Like that's not, for a business, you want the actual operating income. That matters. And look at the light blue number there. That is improving, and that's what you'd want to see. That gives you a little bit of headroom to do stuff. Foundry's been bleeding forever and ever, amen. It is still bleeding. It is not improving. This is page 8. So we go from the revenue, pretty flat. The actual wash is also pretty flat. So if you're wondering why Intel's struggling, we've said this a number of times. Look no further. You can see the revenue here is 1.2. 2.2, 1.3, and then negative 2.5. So that's why it's so tight. In addition to all their other segments, you can see that that's also pretty low. This is -8. That's not negative like. See, this is in billions. This is in millions. So it's not -8 billion. It's -8 million. So it's a much smaller number. So I think this is what matters. This is their outlook. Q1, what do they think? Revenue is going to be down. Gross margin is going to be down. Earnings per share is going to be down. That's not good. That's, however, if you look at what they think they're going to do, and we look at what analysts think they're going to do, I don't see this as being as bad. The big thing is going to hinge on whether or not they can get their local manufacturing up. If they can do that, earnings per share is going to look great. It's not right now. Would I sell them? Boy, that's tough. What does Market Edge think? They want to avoid it, so maybe I shouldn't. We always disagree with them for some reason. Short interest is in coverage is pretty low. The key takeaway is this. If you wanted to take profit, I think you could. And I don't think you'd be in trouble. You have to find something else to buy. That's why I'm looking at United Health here. But honestly, over the next 2 to 3 years, I think the stock is going to keep going up based on what they're doing. That doesn't mean that like the market could change. We're going to go into recession. There's going to be other problems that happen macroeconomically that'll affect it. If oil goes through the roof, then that'll affect it because you need oil to make everything. And that includes like shampoo, conditioner, soap. You need oil just to run basically everything in the economy. So that should affect them. I would say that as far as Intel, it would affect them less than it would affect somebody like UPS. UPS, oil affects the price of gas. 1 penny goes up by $1 million in their operating costs. So if the gas, let me explain that better. So if gas goes up by 1 penny, the cost to UPS to run for a single day goes up by $1 million. That's not going to be as directly correlating to a company like Intel. I think other people see this too. As far as the opportunity to gain another 156%, I don't see that happening. Their fundamentals have to change. Foundry has to make some money. And in order for those things to actually happen, you have to see them complete their facilities and actually get a customer base. They're working on it. But I think that if that happens, you could see some pretty positive results over the next 2 to 3 years. This is not one where you're going to buy it and like sell it in 6 months. That's going to be another 2-3 years. So would I take that and sell that? Well, that really depends. We have to have somewhere else to go. Do I think the gains that we've made, are they locked in? I think at least 100% of that's pretty locked in for now. How long that lasts, I'm not sure. It's a cyclical industry. We'll have to see if they can get past this negative 1,000 PE ratio. That's not actually their PE ratio, but That's what the Schwab account shows. So the next one I want to look at, and this is the last one today. So if you have a stock that you want me to look at, sans Brian, and get all nerdy and all mathematical about, which he's very good about me roping that in. So I'm sorry if you've had to put up with that today, but deal with that. This is what makes us good at stocks. The next one here is United Health. I think this is a value mismatch. They have been just destroyed the past few years. The CEO was shot too, so that's shot and killed. They are trading right now pretty close to where they were back during the pandemic. So if that gives you any indication. And then look at what happened. The pandemic happens, the huge bubble happens. Everybody thinks, oh yeah, they're going to make a ton of money. That's awful. Don't profiteer off of stuff like that. Spoken by somebody who owns Pfizer and General Dynamics. But anyways, and Johnson Johnson. But this is, I think, overblown towards the negative. So if we were to look at where they've done, let's take a look at these guys. Not Max. I want to go back and look at 3 years. There we go, 3 years. So 3 years ago, this is 2022, 2023, we have trading at $500 a share. They're at about $300 a share. That's a huge difference. The CEO, this is when that event happened, plus all of the lawsuits. There's a few things going on with them. I think, though, that the industry that it serves is not going anywhere. You've got a huge bulge of the boomer population in the United States. They need healthcare. They need insurance. Are the people at the company all bad? No. You might have a few bad apples, but that every place has that. Is the industry that they serve durable? Yeah. You need medical insurance, and if you don't have it, good luck paying for anything. So that's kind of why I'm positive on this one. If you look at their annual income statement, so remember, this is a company that went from $500 a share now to $300. Not quite a 50% cut, but they got slashed a lot. Let's go back and show you that. So when you look at these numbers, keep this in mind. Over 3 years, they're down 40%. Go into their earnings statement and you take a look at how they're actually doing financially. Does it justify a 40% drop? I would contend that no, it does not. If you go back to 2023, they were making $290 billion and net premiums earned. They're up to $352 billion. Total revenue is up a significant amount as well. So you got 371 to 447 in the same period of time. If you go back to 2021, because I'm going to use that as the anchor point here, this is kind of what we did for 3M. So if you're familiar with what we did on 3M stock, we took that over the course of a couple of years. We found undervalued stocks. So even back to 2021, they were still trading at $360 a share. You can see that goes all the way up to about 450-ish before 2022 starts. So this is a company that historically is trading way below what they normally do. Now remember, if you sell a stock, somebody thinks it's worth more than you do, or unless the company's buying a share back. If you buy a stock, somebody thinks it's worth less than you do. So you have to ask yourself why. And this is what we're hopefully trying to do in this question. So let's go into, real quick, the balance sheet 2025. If you look at their assets, they've gone up over 30%, so 212 to 309. If you look at their liabilities, they've gone up by about the same number, but this is a growing business. Matt says, I feel like making a profit off of something negative like a pandemic isn't necessarily a negative. In a way, you are extracting what positivity that you can by at least profiting, not profiteering. Yeah, that's kind of what we did with XYL. Because of the water crisis in India, we wanted to invest in businesses that were going to contribute to the solution. You don't want thirsty people. That's not good. So what company is going to actually be able to help these people continue to survive? Because water is kind of a survival thing. So we bought XYL as a position company that will help with that. Now that we bought them recently enough that we could add to those shares. I think when you're profiteering off of something negative like a pandemic, you got to be real careful about margins. In my business, I don't have hardly any margin in hardware. I don't have a lot of margin in labor either, but I publish that. So like if I sell a computer or a server or something to a customer, they know what we make on it, and it's very little. It's a very small amount. I wouldn't change that number just because a pandemic or like a supply constraint happened. That this I wouldn't be opportunistic that way. So when you're looking at a business to invest in a situation like that, what I would be really not happy to see is if a company like XYL or Pfizer and J&J manipulated pricing with like the EpiPen thing with diabetes treatments. As an example, something like that, I would not want to see the business do that. I think it's ugly to look forward or worse to orchestrate a negative or to profit from it. Yes, I wouldn't celebrate the negative. No, that's Michael Burry in The Big Short. They were after they made all their money, they're celebrating in the bar, and he stopped. He's like, "Hey, do you realize like quit celebrating? We made money because other people are suffering. Don't celebrate that." And he was, I don't think he was wrong. In this case, when you're buying these companies, this is before a major event. Um, I think that United Health did have some structural problems, but the people that are left and the people that they bring in to fix that, I think could probably fix some of that. Will it eliminate all of the structures that surround corporate greed? Probably not, but that's across like the entire stock market. And if you, in fact, if you want to know how that really looks, what I would encourage everybody to do is when you go to your 401k, you look at your 401k and you make your deposits, take a look at the fees. Those are eating your returns pretty bad. Every single time you deposit into your 401k, the entire industry benefits from that because usually when you buy a mutual fund or an index fund, you're putting money into the overall market. So even if the company is managed poorly, you're still giving them money. In fact, if you have a mutual fund, you're like, oh, I don't like those big, United Healthcare and Pfizer and Johnson companies. Those are terrible companies. I'm going to be altruistic. Really? Okay, well, you better stop buying mutual funds and index funds because companies like Nike and all the other big ones and Pfizer and Johnson and Anheuser-Busch and United Health, they all benefit from mutual funds and index fund purchasing. They're in the Nasdaq, they're in the Dow. They make money every time somebody deposits into that account. So you can say it, but you have to understand what those accounts really mean. So as far as like your 401k profit and fees, that's what you don't want to see. Is usually those fees are relatively reasonable. They actually publish like this is how much it is when we buy if we buy a stock on E-Trade or Charles Schwab, it does tell us this is your fee. It's not terrible. If I bought United Health today, you would see what that is. But that even happens in your 401k. So if you think, well, oh, I'm going to make a ton of money just by doing that, pay attention to the fees. It's oftentimes better to put a lot of money into it. So the fee relative to what you're doing is a lot less. Some of those fees are percentage based. In that case, doesn't matter. Some of them are flat rate. If they're flat rate, you're getting your lunch eaten if you're only putting in $50 a month. It's better to do that than nothing, but keep that in mind. So anyways, another nerd rant with Tom. Matt, you pulled something out of me. Brian's usually pretty good at that. Thank you. One of the things I like most about your stream is how you have ethics in your investing, at least until we get bought out and sold to the cheapest bidder. No, we're not sponsored. I pray that I do not end up like that. Look at Robert Kiyosaki if you want any evidence towards somebody who sold out. Sorry, Robert. Not sorry. He used to be so different, and then he just changed. Maybe he was never that. Maybe he was always this way and he just never said it. We'll have to find out someday. Maybe we can talk to him. I actually do like a lot of what he says. Same thing with Dave Ramsey, but sometimes they say stuff, probably even me. If I say something, you're like, oh, what is that? I don't agree with that. It's fine. You don't have to agree with me. And that's the beautiful thing about life is you can disagree and still get along, still be friends. As far as like United Health goes, I'm going to go back to that. Their total assets, their total liabilities, their common shares outstanding, these are good numbers. Everything on this balance sheet looks good. 941 million shares outstanding, down to 906. Everything here looks really good. So income statement. Now remember, this stock dropped 40%. I just went through their balance sheet and showed that everything was growing by 30%. So that's a 70% difference. It's pretty good opportunity play. So total revenue, if we go from 2021, back when they were trading, like, what was it, like 450, I think is the high number. They were at $287 billion. Now they're at 450, roughly, billion dollars total revenue. That's pretty good. Operating income is down. Okay, so that's something that matters. Operating expenses have gone through the roof. This is where their problems start. So this makes sense for the drop. You went from $24 billion down to about 18.5. So if you were to reduce that, that's about a 25% drop in operating income. This is Tom math. This is head math. You are welcome to grab a calculator and correct me all day long. I encourage it. Troll me all you want. So operating expenses, $263 billion, all the way up to 428. So their costs have gone way up. I get why, and I know why that's happening. But if you're talking about overblown on stock sale, I would expect that the operating income numbers and the revenue, because they've ballooned so much, that the stock would not have dropped 40%. I would have expected a 15 to 20% drop with just that. Look at their net income. That is also, yeah, it's all over the place. 17, 20, 22, 14. I sound like an auctioneer guy. 12. So, okay, this is where we want to look at their report and their future guidance to kind of correlate those two numbers. I put this in AI, and AI said that I think this is a value mismatch as well. It pointed me at Pfizer, said we're a little bit too late. It also said that Intel is a non-starter, wanted me to sell Intel. That's why I'm kind of questioning. I was like, I don't know. I think I'm longer term than you. But cash from operations, same thing. So they've got cash. There's this nice thing I like seeing about them is these guys are buying back shares. They're reducing their overhead, and I like seeing that. If we look at how much debt they have, that's a bad number. That's a bad number. Overall, it looks like there's a share buyback. So we go 5, 5, 5, so 15, take off 3, 12, add 3, 5. So they're actually reducing it here. This is annualized, just so you know. If you look at they're reducing it here, they're increasing it here. So what I'd be curious is if they're buying back and repurchasing shares, that's a good thing. That drives the price up, or is supposed to help stabilize the price. And they're issuing long-term debt. What is the rate of that long-term debt relative to what they paid off? If it's a lower rate, that's actually a good thing. If it's a higher rate, it's not bad. Now here's the cash is king statement. This is annualized. This also justifies a little bit more of the price drop. So if you look at the net change in cash over the past 5 years, you went from 4.4 positive change to a negative almost $1 billion in change. But look how much cash they have. They start with $16.9 billion just sitting in their bank account. Think about what we've all talked about with things like inflation and the cost of eggs, cost of gas, cost of milk, cost of all this other stuff, to what it is. Let's see, what popularity? Buy viewers on Streamboo Live. Why would I buy viewers? So, all right, Deadly Cave, thank you for watching us on Twitter, but I gotta troll you a little bit. We are offering investment advice to people who we're gaining on average about 20% per year, plus 50% gains at least on average on stock sales. We're doing this for free while encouraging people to get their own financial advisors. So over the course of 20 years, somebody putting in $400 a month is what our portfolio started with, would probably become rich. Now, there's a lot of things that can happen in 20 years, but we're doing this without getting paid. So I'm not sure I need to buy viewers. We're not desperate that way. I mean, if I was, I wouldn't have a $125,000 portfolio I can't touch. But anyways, no, we're trying to do this to help people. I want to try to make a difference. We went to YouTube, and Brian knows the story. Matt, you've heard the story 5,000 times. I'm sorry. In the social media space, YouTube, Rumble, especially like Graham Stephan did a really good video on this. And there's been other videos where you've got financial influencers on YouTube and their average gain is like negative 60%. It's awful. These people don't know what they're doing. They get paid for companies that are not profitable to promote these companies, like pump them. And then while people are getting in onto the emotional bandwagon of, oh, I'm going to make 5,000% tomorrow, the YouTuber and the other people that sponsored them are selling their shares or getting equity into their business so they can grow. This is a well-known phenomenon. This is why most people say buy an index fund and like VTI and VOO and chill. Like that's why they say that stuff, because there's a lot of greed, there's a lot of manipulation, and there's a lot of just, quite frankly, just bad information out there about how these companies actually work. One thing that people need to understand, the stock market is not a casino. It can be, it acts like a casino, but underlying businesses, when you buy a share of a business, I remember I was streaming with Brian. We did actually a video, not a stream. We posted in the video that I feel that when I buy a stock, I'm giving the company a loan. I want to know how they're going to pay it back, when they're going to pay it back, and what they're going to pay it back with, and what the certainty is that they're going to be able to do in a worst case scenario. And some guy comes on and he trolls me on YouTube. He's like, oh, it's not a loan. It's like, yeah, I know that. I know it's not a loan. I'm not stupid. But it's the money that I worked hard for, that I earned over a long period of time. And when I invest it, I expect that the company will be profitable to be able to take that money and do something positive with it for themselves and for us and pay us back either in share price appreciation or dividend checks. That's why I view it as a loan, because why would I give it to them? I just go out and I buy something else. I don't need to give it to them. So in this case, when these companies are like, when you buy, I don't know, in this case, United Health, probably looking at buying United Health. I like what I see a lot. And as far as cost basis, when I'm looking at this business, you got to believe too that when you're buying a business, Zim is another example. They were $80 a share, very hyped. Now they're down to, I think, like 23, 30-ish, something like that. They've been recovering from and you can go back and look, the $8 to $10 share price that I said they would be at. The casino part of the stock market is very loud, very persuasive, and very emotionally driven. And so many people get caught up in it that they forget to look at the actual company that they're buying. They talk about earnings per share. They talk about price to earnings ratio. You look at the Yahoo article I just talked about all of this, because the person buying the company, in this case Intel, was saying that, oh yeah, I want to make money. That's why you buy a stock, right? You want to make money. I do too. I want to make money too, but I also want to make a difference. And sometimes that means that you have to see past just those numbers and see what the business is actually trying to do. Now, granted, at $100,000, there's not a lot in this portfolio that's going to make that kind of, well, 130,000, whatever, is going to make that big difference. But over time, this builds a foundation that if you take the investment income and you start saying, hey, this $320 a month, I believe in Rumble, as an example. I believe in freedom of speech, or XYL. I believe that we need to solve the water crisis, and you take some of the dividend checks from companies that are being sustainable, and you say, hey, let's go in and let's buy businesses that are actually going to help the human crisis, if you will. Then you take that money and you did it. We did that. If you look at Rumble, you'll notice we've got $3,000 in Rumble. That was paid all through dividend checks. I didn't take money and just throw it at Rumble without actually having principal to invest somewhere else. So I didn't take any principal funding for that. I bought Rumble because I believe in what they're going to be doing with dividend checks. I didn't have to work for that money. And the same thing goes with XYL. XYL was a principal investment that was not dividend check money, but because we're putting money in every month, not a lot. The average we're supposed to be telling people is $400 a month. But we bought this one because we see a problem with the water crisis that almost nobody cares about, nobody's talking about. I think it's really interesting too in Iran, where a lot of this stuff is going down. Climate change, whether you believe it or not, does not help with the fact that Tehran is a giant desert. And if you look at the NASA measurements for groundwater in that region is depleting 3 to 5 times faster. You can go to the NASA website and take a look at it. What they have is these satellites that gravity will pull them lower or higher based on where they are in the orbit. And the reason why they go lower is the groundwater weighs more, so it'll push the satellite a little bit closer to Earth so they can measure how much groundwater there is. And they've been taking these measurements for a while. So if you look at the measurements they've been making, is they've been discovering that groundwater has been going down 3 times faster than surface water. So one of the problems that we have in Iran specifically, so let's talk about like you going to your kitchen faucet and turning on the sink and nothing coming out but maybe sand or a drip. That's a real reality in a lot of these places. India is also in the same place. They've probably got about a 54% chance that they're going to actually fix it before it becomes a big problem. I think they said that somewhere over, that's what AI told me anyways. I think it's a little higher than that. They have 50% of their water is like run off through agricultural and it's not like maintained well. They're going to try to fix that problem. But I think a company like XYL could be well positioned to help them through that because they're already in the space. They already make all the equipment and they come in there. The legislation, the government can help fix that problem. In Tehran, that's a little bit more complicated. They basically have a dictatorship slash theocracy, and that theocracy has almost no qualms with letting all of their people suffer. I mean, look at the people were protesting. Some of it was economic, some of it was the actual loss of food and water, and some of it was just like religious oppression, and they shot them. So XYL is not going to fix that problem. That's much more serious. However, as a investor, you can take some of the money that you get from the foundation here and you can allocate it towards businesses that you feel that might actually improve the human condition. So we'll see. So that's kind of where I'm going with this. We don't necessarily need to be popular to do that. I do it personally because I have to. My company has about 7 employees. It's about 6.5. I got a guy who's part-time. And with the accountant and everybody here, it's a tiny little company. We can get stepped on tomorrow. But and that's the reason why I do it this way. What I will do is I'll take extra revenue from the business. If we get anything, some months we don't get a lot, and I will invest it. And I will take the dividend checks from those investments and I will pay benefits to my staff. And with about 6.5, 7 people, I need about $350 of dividend checks to increase like an HSA disbursement by $50. So totally nerdy math, not that exciting. What it does is I'm trying to take good care of my customers, but if you look at what it does over time, so right now, if I take the $5,000, I'm probably will buy United Health based on what I'm seeing. I'm kind of think about this while I'm talking. But before I get into their group reports, before I purchase it, I want to cover this. So over the past 6 years, we've grown from nothing, basically, me and the garage, a couple $1 million company. And I've been able to make increases to my staff's payroll so much so without customers having to pay more. So this benefits them, it benefits my staff, and it keeps the company rigid. So this is why we do dividend dues, not because I'm trying to become popular, like that guy wanted me to click on that link or whatever. I have to do this for the sake of my business. We've been able to take our benefits plan and pay all benefits. So everybody at my company gets 100% medical. It's a HSA high deductible plan, but the out-of-pocket max, I think, for a family is like $6,000 or $8,000. It's not very high. The deductible is $3,000. That's all paid for. So for a family, I got 3 kids. It's about $1,200 a month. That's paid for with dividend checks. So Paid all that through dividend checks. So that's for everybody at the company. They don't have to pay anything. 100% benefits payments. The other thing I did is we started matching the HSA and increasing the HSA. So now the HSA is up to $450 a month that the company just gives them. In addition to that, the payroll now provides 3.5%. It's not a match. So this is just a deposit directly to their 401k. So they just get that on top of their pay. In addition to that, 100% of the mileage is covered. 100%. You drive somewhere, you get it paid. It's all yours. In addition to that, ancillary benefits like short-term, long-term disability, vision, dental, all of that is also 100% covered. In addition to that, we pay $75 a month towards their cell phone. In addition to that, I pay $100 a month for a gym membership. In addition to that, they get about $3,000 of benefits for technology, like cell phones and logo clothing, which I'm not wearing right now, laptops, you name it. And I live by that. Like the people see these numbers, even my customers, I don't have any problem, they all see the numbers. They know what my margins are, how paper thin things can be sometimes. But I will take that and give them those benefits. In addition to the other ones I just talked about, they have 4 10-hour working days if they want. And they also get to work remote 1 day a week. And they are expected to go to the gym at least twice per week, either before or after or during lunchtime, where they can actually stay healthy. So 3 weeks of paid vacations, 1 week of sick, 1 week of PTO. So they basically get a month off. So what I'm trying to do is, I can't guarantee that the IT company is going to exist tomorrow, but what I can do is take the extra money, invest it, and treat my people well through that. That is why Dividend Dude's portfolio exists. So pretty much the stuff that I'm buying here, I have to be defensive because I have to depend on that to help run our benefits. Now, I do have some margin in the business, so it's not quite that super tight. But in this case, I need to make sure that in my company, if I get a dividend check from Fastenal, I have to make sure that Fastenal can continue to pay for that dividend check. And I also have to be very careful of a company like NLE Capital paying, what do they say, 13%? That ain't 13%. That's like 8%. But I have to be very careful of whether or not they can afford it. Because if I'm going to justify, hey, I bought this company and they're going to pay me $50 a month, I need to make sure that that's at least the baseline. And then I can increase that. Over the past 6 years, we started with no benefits. We started with none of that. And we built it up. So whether or not I have a YouTube channel, whether or not we're popular, whether or not we actually get a sponsor and get sold out somewhere, I'm doing this anyways. I'm going to do this whether or not I have a YouTube channel because I have to. Like my personal finances depend on it. It's very different. Even my own life, like my house is paid for, the Porsche is paid for, the M3 BMW is paid for. I have a full tractor with a cab that's paid for. $1 million house is all paid for. My 8K TV, my home theater set up with the AVR 10H Denon, that's all paid for. My grand piano with 7 foot with a player, that's all paid for. It's all paid for. The house I only paid $400,000 for, so my cost of living with a household of 5 is below $5,000 a month with private schooling. So I can basically go work at McDonald's and pay for all my bills. So all of the extra money I get, and I am remodeling myself, it's a pain in the ass, excuse my language, it sucks, but all the extra money that I get goes towards this to take care of my people and take care of the customers that work for me that said, hey, we believe that you guys can do a good job and we'll try to do that. And I intend to keep doing that. So I'm sorry for the soapbox, but it does annoy me when I see signs of that whole me, I want to go, that whole culture just try to prevalent itself and push its way into our social media space. I don't need more income. I need more stability. The company needs to be stable. The dividend checks need to be bigger. The staff at the company need to be well cared for and not have to worry about their jobs. Small businesses are very, they're up and down. I don't have any debt in the business, so that helps a lot too. So if you're wondering why, this is why. That's why I'm doing it. I don't really have a choice. And I figure, hey, if I'm doing it personally, I might as well bring it out publicly and try to help a few people along the way. We'll see what they say. And so far, we've been doing pretty good. All of that said, if you got questions, Matt, you said you aren't like the chest pounding to the moon vloggers. We might be. I don't know. AT&T makes us sign something. We might be. Hope we're not. Sound like an awesome person to work for. I've been told that a lot. I've had some people take advantage of me. My company has not been without turnover in the past 7 years. I've given some pretty big bonuses. The largest one was $20,000 to somebody. I also helped pay a down payment on somebody's house. So maybe I'm generous to a fault, and that kind of taught me why I need to do that through investment dividend check increases. If I'm not being a good steward of my own staff, my own company, I can't be a good steward of the customers that work with us. So therefore, I need to be careful. And that's kind of where all this started. Personally, I've been investing for, man, long time, 2004. So heavily since 2004. So I lived through the recession. I was kind of speculating on the stuff during the dot-com bubble. So 22 years of this. It's hard for me to translate when I look at something like United Health's balance sheet. The numbers, like when I look at this, this is not normal for most people, and I get it. I'm not normal. But when I look at the balance sheet and I look at these numbers, I actually see a story. I kind of have an idea of what's happening. That didn't just materialize overnight. If you want to see what that looks like after 40 years, look at Jim Cramer. He can look at that and see that in like 2 seconds, and everyone's like, "What? How does he know that?" Well, he has to be flamboyant, and he likes pressing buttons, which I do too. But that's kind of if you've been doing this a long time, you know what this stuff means. You know what it says about the business health, and you can kind of make a pretty good 5-second judgment of whether or not you should dig deeper. That doesn't happen overnight. That's something you have to just keep doing. It's kind of like learning the alphabet or just like getting better at a specific language you're trying to learn. You learn one letter or phrase at a time and keep working your way up, and eventually you become fluent. So if you follow along in the channel, you got a financial advisor, don't expect to get all of the terms and don't expect to understand everything we're talking about. Just try to grab like one or two terms, figure out what you can, learn along the way. And then if you've got questions about stock, I have no problems with like looking at a particular business and just seeing if it might be a good buy. I might get annoyed because social media talks about the same 20 companies all the time. And every time we like post this question, we get comments and people are asking us about the same 20 companies that everybody else is pumping. So it's like, oh, not again. They're telling me the same thing. But I will go through it and we will do our best. Eventually, as the channel gets bigger, probably what we're going to have to do is like separate that out, because if we get enough people in the stream and enough people looking at it and enough comments for people asking for stocks and like what we think about them, we're probably gonna have to separate the people who pay for subscription. It'll be cheap to help like go through those, and then the people who don't, because I'm not going to be able to look at everything. It's too much. We've seen that happen twice now, where during a stream or during a video, we're like, "Hey, tell us what stocks you want us to look at." We got like 35 stocks, and I go, "Whoa." Can't look at that many over week. So anyways, that's the whole thing. If you're just tuning in, I just went on a giant nerd rant about life and the meaning of life and Artemis 2. If you haven't seen those images from the other side of the moon, that's amazing. You should go check those out. Can't imagine being stuck in a sardine can for that long, but I would do it to see that image. That's amazing. Anyways, before we move on, and actually buy United Health, I want to just kind of do a fact check on myself and see. They say here, this is I don't know if I posted this or not. Let me make sure I did. I did not. Okay, so here is United Health, their outlook. And we just took a look at, and I didn't talk about all of it, we just took a look at their balance sheet, kind of what was happening with the business. We saw some red flags. We saw why the stock price dropped. I would contend that maybe 25% would have been sufficient. They dropped more than 40%. So in this case, adjusting earnings of $16.35 per share. The revenue, they're looking at adjusted earnings going to greater, well, they say greater than 1775 per share. So let's go look at that real quick. Historically, they have been much higher. No, we've got 720. So this is annual guidance. So you have to add all these numbers up. So we got 7 plus 450 plus maybe 3. Yeah, so that's I'm going to go through their actual. So 7, 4, so 11, so 14, roughly 16. So they are increasing. So that's an increase. That's not a decrease. That's a good thing. If you look at compared to their peers, how that slides in there, man, their net profit margin is so thin. This is where when people say, "Oh, those insurance companies," yeah, they make money, but they don't get to keep a lot of it. They get to keep 2.86%. Can you imagine that? If you made $1,000 and they were like, "Here's $28." Like that's all you'd get to keep. $28.60. That's your take home after making $1,000. That is kind of like what being an employee or even a small business owner is like, but I think that's a good sign. So they reported that their consolidated revenue was 447 billion. We saw that 12% growth year over year. Earnings from operations were 19 billion, and net margin was 2.7, while cash flows were 19.7, 1.5 times their net income. That's not too bad. So the outlook, this is what we wanted, was set for more than $439 billion, with earnings from operations greater than $24 billion. That's a huge increase, 20%. And those are justified by all of these numbers. You're not going to see this if you go to like your stockbroker, if you've got a Robinhood or whatever your account is, this won't show up because these don't show up until the quarter after they do the statement. So if you want this, click the link, open up the PDF, and it'll tell you that. What I'm seeing here is what they're looking at is they're actually showing that they're still improving. There are some lawsuits that can change this. Just like with 3M and the masks with the military. But I don't see this fundamentally altering the 40% drop that they've received. Optum Health, that's part of what they got. I think I'm going to pull the trigger and then like justify it to Brian next week so he can yell at me. Maybe that'll be good TV. I don't know. Good viewing, good streaming. Sorry, but not sorry, Brian. Okay. Forward-looking statements. Oh my gosh, it's a lot of words. Can I search for the word words? See what they got? The words believe, expect, intend, estimate, anticipate, forecast, outlook, and similar expressions identify forward-looking statements. They have to actually, that's attorney speak, people. That's ridiculous. Okay, let's go here. What they expect. Do they expect the same thing that analysts expect is what I wonder. What am I seeing? What am I looking at? Cash flow from operating activities. So they were at, in 2024, they said they were at 24 billion. They went to 19.7. Now they're expecting to go back to about 22 to 24. At least I think that's what they said. Let's go look. What did they say? They said, yes. Earnings greater. They expect 24 billion. Okay. So they expect to go back to where they were. They did get hurt pretty bad. They still haven't fixed all their problems. I think I like these guys. I think I want to do it. And we don't need to look at all the rest of the stuff. So if we go to net earnings attributable, yes, I know this is boring. I'm sorry, but I'm not sorry. I have to do it. And you all know why. Now you all know why. Man, they've already made $113 billion. It's only April 10th. Good Lord. That's a lot. The net margin on that's really tiny. That's not surprising though for insurance. Heavy regulation and just major events make it very bean counter tight, and that's not unexpected. So I think what I'm going to do now that we looked at Intel, I don't see a reason to sell them just yet. If you're from Intel and you're an investor relations person, you want to talk to me about why I should not sell and capitalize on my now 156% gain, I am open to a conversation, because that's that's quite a bit of money that I could be getting dividend checks on that I'm not. But that's just me. So I think what I want to do is I want to sort this by cost basis. Let's do that. And now let's take a look at which ones I could theoretically buy with the $5,000 that we have. The cheapest one, AT&T. Moving up the list, we have United Health towards the bottom. They're at $3,000. Our top one is Intel at $9,400. I bet the bank on them because I saw a pretty big opportunity. I don't see quite the same opportunity with United Health. Intel was a multi-bagger. I knew that was coming. United Health, though, I could add $4,000 to them and it would still only be $7,000. So they wouldn't be the top. They would be number 3. So I think what I'm going to do is I'm going to do that. I'm going to go in and we're going to buy some shares. If Brian starts texting me and blowing up my phone, I'm going to laugh. What are they selling for share? They're selling 300, something like that. Yeah, $305 a share. So if I buy 10 shares, I got $3,000. I could buy 15 to get 4,500 because I've got 4,700. Now this is Tom math in my head. I did not plan that out. So if it's wrong, deal with it. I think I'm going to buy 12. No, I'm going to buy 11 shares. Because Brian's going to want me to buy more Rumble. He may not. He might not even care. But I'm going to do it anyways. All right, so we're going to buy 11 shares. They do not pay a huge dividend right now. They pay, let me go to that. Let me finish this up. See, you get real things with real timing here. That's $3,350 for $4,700. So we got some wiggle room there. Now check it out. These small orders. If I go to order status, it's already filled. And you can see here, there's our ExxonMobil sale. And I did that like the day after the Strait of Hormuz opened. See? Yay. And our price improved a little bit too, so I got a little bit better deal on them. We made really good money on that one. Thank you for that, ExxonMobil. I will come back to you later when the FOMO and the day traders are done doing their thing. Okay, so we bought United Health. I now have $1,400 left, which is kind of about what I wanted. Kimberly-Clark has been bludgeoned recently, and I think that might be a pretty decent opportunity. So what this does now is if I look at our cost basis, I got to sort this again. You can see Intel, why aren't you showing up? Where is it? There we go, United Health. Okay, so we're at 6,313. A little bit more into Campbell's, a little bit more into UPS, Devon. I think what I want to do is I'm going to add a little bit more to them. I want to get them above the other plays because I don't plan on buying more of United Health for a little while. So I'm going to add 2 more shares to this. Notice how I'm weighting this based on my portfolio, not trying to go over too many stocks and not under. There's a reason for that. It's called diversification. If you don't know what that is, it has nothing to do with... There we go. So 2 market shares. It has nothing to do with equality. That's better. That's what I would have expected. Okay, so now we're pretty average across the board, just under $7,000. They do only pay a 2.89% dividend yield. That's fine. I've got just under $1,000 left. I think our dividend checks, let me go to the investment income, take a look at that. That is now back to $338, so we didn't actually get any pay cuts. That was because of my stock sale. If we look at 2026, It is March, so I have to go based on March's dividends. So I've got $437 of dividend checks that I can use to buy Rumble if I was going to do it. And then I've got another little bit. But if I go and I look at Rumble, I'm not sure. They're kind of in the middle. They're down today. So I think what I'm going to do, I think I'm going to do this. I'm only going to buy like $200 worth, just a little tiny amount. I'm only going to take half the dividends. So what are they trading at today? They are at $5, $5 a share. Yeah, just under $5. That's a pretty good price. So if I bought 40 shares, something like that, should be 199. I was off by 40 cents. $199.60. How about that? Gonna buy them. There we go. Thank you, Rumble. Order status. Keep doing what you're doing. That's filled instantly. And then I've got a little bit more. And I think the one that I want to buy, and it's I don't think Campbell's Soup is quite there yet. I need to see another earnings statement before I do that. The other one I wanted to look at was actually ADP. ADP has been getting beat up for absolutely no reason. And it's tax time. They tend to go down at around tax time. They go back up towards the end of the year because they do all the reports. So this is a really good time to buy more ADP. Probably be looking at doing more of them for next month. So this is May. This is after they come out with some of the reports. So ADP is a 3.39% dividend yield. Now remember, it's a low yield, but the chance of them growing that dividend check itself over the course of a period of time, like years, is huge. Let's just look at that real quick so you can understand some of the logic. I'm going to close all these out. Campbell's Soup, I'll keep them open. Look at them, close Intel, Robert Half, and then these other ones here. Go to ADP. All right, so we're on ADP. Let's look at dividends. I've had these guys since 2008, but let's take a look at this. The dividend check has gone up by double digits almost every single year. 17%, 12%, 5% during COVID. 2021 was 14%, 18%, 11%, 10%. And it's not like a huge payout either. It's 60% of their current earnings right now because they're in a little bit of a rut right now, but they're still able to cover that 1.5 times. So I think as far as our portfolio goes, this one here, I think I'm going to just add a little bit to ADP. So we got $619. I think I'm going to buy, can I buy 2 shares? Yeah, I can buy 2 shares. I'm going to buy 2 more shares of ADP just to even them out a little bit. And that should bring our income over the $340 threshold that we needed to get us that Honda Civic on a lease for the rest of our life. So now in this portfolio, if you were diligent over the course of 3.5 years, you now have a car for the rest of your life that you never have to worry about ever again. Oh, I can buy more than 2. I'm going to buy 3. I can buy 3 shares. Think about that. Short-term pain, long-term gain. I know it's hard at first, but boy, does it start to work. All right, so now we're down to a little tiny amount in cash. We got ADP. If I sort this by cost basis, this gives me not a lot of options as far as the low ones. They've grown too much. This one, Rumble, maybe, but that's a risk play, so I can't go too far with that. Procter & Gamble looks like the next big one. Maybe Campbell's Soup. But I can't go too far beyond that. So let's go back, look at income. Let's see where we're at. We're up to 130,000, almost 131,000. Hey, investment income. Next 12 months, we're over $340.61. So that really is buying a Toyota Corolla or a Honda Civic on a lease for the rest of your life. If you got an existing car and you got a down payment, you can use this to pay the payment on the new car. That's and I would say this is pretty reliable. The only one I'd be a little bit worried about is Annaly Capital. But if we really wanted to, you got to keep in mind too, Intel's not paying a dividend and Rumble is not paying a dividend. So I could take those two. Intel by itself, I think it tells me, it doesn't tell me the total market. There we go. Market value. Intel is $24,000. So I could take that and add that with a 4.5% dividend yield, and I could get another $80. So I could very easily go over $400 a month without any problems in this portfolio. Very easily. We're not going to do that yet, though. So we are now reliably able to pay for a leased or a purchased car that has a down payment on it for the rest of our life. Not a bad thing. It took us some money left over for a horsey ride at Meyer. Yes. Or watching a pay-per-view midget fight club. we have enough left over. This is what a lot of people don't understand about investing. It does take time, but man, it does work. And you're starting to see that right now. Now, I would contend if you look at Joe Carlson, you look at a lot of the other, and I call him out specifically because he's one of the better YouTube finance guys. There's quite a few out there. They bought a lot of Magnificent Seven stocks based on growth. He is putting a lot of money into his portfolio every month, watching it fluctuate all over the place. A lot of it's negative. You'll notice that he's trying to offset the losses. When you buy a stock purely based on growth, you could make a lot of money, but when the market, I think it was, I don't know if it was Benjamin Graham or Warren Buffett said it, but when the market actually crashes, you're going to see like who's swimming naked when the tide goes out. And that's kind of what happened. You're going to see the people who made these really high, heavy bets in the stock market that are based purely on speculation and growth, they're going to get punished very harshly. A portfolio like this will not, it'll be punished, but not like that, not nearly as much. And this income, like I said, if we do actually go into recession, there actually is a crash. If that does happen, I don't have my crystal ball, but this will probably go up, not down. Most of the companies, if you go to our, we'll probably do this next week. If you look at our Seeking Alpha account, the profitability is always like A plus, A plus, A plus, A plus. Like they're all making really good money. So base it on that number. Don't base it on this like massive 238% gain. This is not a realistic number and not an equitable number for you to be able to use that money for life expenses. Obviously, you need a financial advisor if you're going to be doing this stuff, but this is the number that I would equate. And for my company, for everything that I talked about for my staff and my customers to take care of both of them, I only need another $10 a month on average, on a monthly average, to be able to give them an increase into their HSA, assuming like insurance doesn't go through the roof, because I've been told we're going to get a huge hit to that this year. So, but they don't have to pay for that either if this hits that number. So we're very close, doing pretty good. I really wish Brian was here because I'm not that engaging without him, but hey, it's all right. I'm learning. We're learning. I think that's all I had. So if you guys got questions, ask away. I'm here. I'm emotional. I'm insensitive. I'm insecure. Financially secure, but I'm insecure. I have a need to prove myself complex. I squeeze stress balls. Regular. I don't know. You got questions? I'm waiting. No questions? And I just see my kids got home, so I'm probably running out of time quicker than I'd like. No questions. Going a little bit longer because I know there's about a 30-second delay. A little bit longer. Let's see what Google AI says while I wait. AI says United Health is currently viewed by many as a significant value opportunity, often labeled a value mismatch, where market fear regarding regulatory pressures and medical costs have driven the stock to a low PE ratio. I love that. I love the PE ratio. 15 to 16 times earnings relative to its historical average, which is over 20. Some analysts suggest it's 50% undervalued and others discount warranted until further earnings stabilize. What are my thoughts on General Mills? Oh, man. I like General Mills. We keep getting this one coming up. What I will do for this is I will save this for next week, Matt, and we can take a look at them. They are right at their low, though. 3 years. 40. Oh, they got bludgeoned, too. a lot of these companies like Kraft Heinz, General Mills, Procter and Gamble, like DuPont, they've all been not doing good, and that's a pretty good indication of what the actual economy is doing. Uh, Dividends are flat. Historical earnings are, yeah, they're still pretty good. You like to see them above 4 times earnings in this industry, and they are. They're right there. Price to earnings is really cheap. Trailing 12 months is 8.97. I don't know if that is their normal. You'd have to take a look at what their earnings per share and their price to earnings ratio was over the last 4 years. If I look at their balance sheet real quick, we can dig into them a little bit deeper next week with maybe like looking at a, what do you call it, like an investor presentation. We could do something like that. But if we really look at these guys, total assets up by about 7%. Liabilities, even less, by like 5.5%, 6%. Now remember, I'm looking at this number and I'm looking at this number and doing math for about half a second, so I could be wrong. Total shares outstanding, the correct direction, unless they're doing some major thing. But a business like this will not be a major, it's not like Amazon was back in 2003. So you wouldn't expect to see shares outstanding increasing. They're not trying to raise capital. Total revenue, 18 billion, 19.5. The one that matters to me, operating income. They are still making money a little bit more than they were before. The cost to make that money, however, went up more by their operating income. And this is where I would say demographics, economies of scale, and the fact of where they do business matters. There's only so many people in the United States. You start going into other countries, you deal with tariffs, you deal with different political climate situations, you deal with like their governing authorities and what they say. That's where when they say, oh yeah, the company can just go overseas and they'll make money. It's like, yeah, it's not quite the same way. The going overseas is great, but the economy over there and the population has to be able to afford your product. So this is pretty much where I would expect to see them. Net income, that's about where I'd expect to see it, pretty flat. Because they got to do stuff with that money. And then if we look here at the earnings per share, this is a good metric that you would see. Some of this, if you look at what happened to Sears stock, over the past 25 years, the EPS number was being manipulated. So be careful with just using this alone. This is not Sears stock. This is General Mills. They have been hovering around for the last 5 years. And this is exactly why I said for this industry, so it tells you I do actually watch this stuff, this is why you want to see them around 4. And they've been doing that, so that's just fine. Cash flow segment, net income, flat. Cash from operations, also flat. The finance and investing. Cash from investing, so they've been acquiring businesses. Imagine that, corporation finding smaller companies to buy out. Never happens. Purchase of investments. So okay. They're doing stuff there. That's a really complicated explanation. Financing. What I like to see is them paying down debt. American economy tends to run on debt, and I like to see them reduce it. So they're exercising a lot less options. This is how much their dividends comes out. Let me see, is that right? Yeah, this is dividends come out of their balance sheet every single time they pay them. 1.3 billion. Think about that. That's a lot. Financing cash flow items. So they're retiring their stock. They've got a less. That's good. They're retiring their common preferred shares. They're not issuing more stock. They did get some more debt, and they did issue some long-term debt, and those two things do eclipse the retirement that they've got. So again, just like the one we looked at a little bit a few minutes ago, we looked at that they were doing the same thing. You want to make sure that the lower interest rate applies to the long-term debt that they're getting. I would not assume that it does over the past 5 years. But if you look at this, there's nothing alarming about this number like you saw with the other business. This long-term debt issued number is pretty much the same every year. So that's not alarming to me. That's just an operating thing. I don't see a lot of problems here. They're leveraging themselves a little bit more than they should. If we look at their net change in cash, this is where I actually see a problem. They went from 1.7 billion almost to about 364. So in order for them to rebuild that to account for a bad quarter or a build, maybe a tornado hits a facility or something to be able to repair that stuff, in order for them to actually pay for that, it's a lot less likely that they're going to be able to do that from cash, and they're going to have to finance that. So this to me says that they're at risk for not being able to increase their dividend. They might be able to decrease it. So I did all of that before we got into the dividend checks. Do I think they're a stable company? Yeah, but yeah, here you go. So their dividend is skirting the edge. So look at 2018, flat 1%, 3%, 3%, down 20%. So all of these gains you had here did nothing for your improvement. Remember, 2018 to 2023, how much did inflation go up? If you wanted pay raises, you didn't get a lot. However, you had a consistent income. So then you go from 2023 to 2025. They had a huge jump. They got back to where they were. They fixed their problem. Good for them. They probably did this to finance a problem or an operational change. If they have to do another one, that's probably what you would likely see. They got to come up with the money from somewhere. A dividend reduction is a really easy way to do that. I actually have no problem with the business doing that because it keeps them profitable. When you look at what they're doing with their earnings and how much their dividend accounts for, that's 60% of their current earnings, and they're covering it by 1.7. That's actually a little bit better than I would have expected. The dividends paid, it's about 3.24%. So I would say that their current 6% yield represents an the 6.6% yield, 6.64. I would say that probably is a little bit heavyweight. I would put them at a 4.7 to 4.5. Their average is 3.24. So I think that if they have something they operationally want to do, this is going to get cut back down to their yearly average. So I would not expect this to be a dividend growth stock. I would expect this to be a value play within the dividend space, which not a bad idea. We'll throw in General Mills to the search matrix, and because I like them. We'll probably take a look at them a little bit more seriously because it's a food product company. This is one where you could buy it, durable products, durable goods, durable company, where they would probably still be able to pay this for a long time, even though in the past year they're going through a really, really bad stretch. So this is a good conversation. Matt, this is exactly where we play. So thank you for that. I'm going to look at this one a little bit more because I like what I see. Man, they're not just at their 1 year low. Look at this. They're at their 1 day low. They're at their 5 day low. They're at their 1 month low. They're at their 3 month low. They're at their 6 month low. They're low year to date. They're 1 year low. Their 3 year low and their 5 year low. If you were to buy a company that's getting beat up, this is they're not having a good time. I like it. This is a good one. Where does that take us back to? We have to go back to the pit of 2018. And we have to 2012. Okay. I like what I see. Matt, we have to find out why. Crown Chocula, the one thing that destroys your children before they even get out of the house. I like this one. I do. I really do. So what we'll do, and if next week, if I forget this, and Brian, if you're watching, or if you watch this later, Matt, remind me next week to look at General Mills. We'll pull up their earnings statement and probably look at them because in the portfolio, we do have enough room to grow. There is enough room here. We only have, we only have 20 companies left now. This portfolio. Yeah, there's not many left. So we have enough room to diversify. I need to make sure I'm not diversifying entirely into the food industry. Oil prices affect them and tariffs on things like aluminum. That's exactly why I like looking at Campbell's Soup. Campbell's Soup here, if you look at the 40% drop, if you look at that one, that's probably due to the tariffs and just their operational changes that they've been doing. I'm surprised Chevron hasn't been affected more by their move. They're trying to get out of Florida, or sorry, Florida, trying to get out of California. Almost said Florida. So I think what I want to do next week, and Brian's probably got some topics too, but I want to look at Campbell's Soup, and I want to look at General Mills. That's a good question. Thank you. That's a good play. That helps us do better. I like it. Okay, that's all I got. Appreciate everybody watching. Thank you for putting up with Just Tom today and Forced Ghost Brian. He's really not there. In case you want to see the prison that I operate from, here you go. This is my space. Ooh. Hopefully the camera didn't go bad. So there you go. This is where Tom operates from. Appreciate you guys. I will see you next week, probably closer to noon Eastern time. And as always, happy investing.